All right, let's get going here. Thank you so much for dialing in today. And I will also, let's see here. How do I do this? There we go. All right, so now you all can see me as well as we're talking, and we'll go ahead and get started. Everyone, my name is Brian Bogner. This call is being recorded right now. When we get to the Q&A, though, I will turn off the recording, and that way we can just keep it very conversational. We're going to take the next few minutes here and just talk through what we're seeing here in the market, what we feel is important, and what matters right now. So if you could, what we're going to try to do is just get through a number of slides, get through some information, and then open it up for Q&A in the end. So if you think of something or think of a question, just jot it down, and we'll spend as much time as you need here at the end and answer any and all questions. Okay, and we've already got some that some of you emailed ahead of time here that we'll also address as well. Okay, great. Let's go ahead and get moving here. All right, so let's go ahead and start and talk about where are we at. And these numbers are as of the close yesterday. So it's always good to take a step back sometimes and see, okay, where are we at in relation to the overall markets? And that's what we're looking at here. We've got the S&P 500, obviously 2016 year-to-date returns, last year's returns, and then for 2014. And as you can see on the S&P 500, it was up 14, barely flat last year, and then it's down about 8% this year. We look at small caps, right? Small caps weren't as much 14, actually down last year, and really down. Actually, it's been the worst, one of the worst areas to be in this year. If we look at developed international, down somewhat, a good bit in 14, barely down last year, down a pretty good bit this year. Emerging markets, a lot of red there. Commodities, of course, we've seen oil prices, oil is a big part of that. REITs, which are real estate, had a great year in 14, again, flat last year and actually down good this year. And the only green that we've seen across the board here is really in the bond market. But again, we're not talking about, other than 14, very, very low returns, but at least it's been somewhat positive. So all that to say that one of the most difficult things about this market is there hasn't been a lot of places to go other than cash and maybe some short-term income, fixed income. A lot of things have been down. So as you can see here, it's pretty widespread, this move that we're in right now. So this is the S&P 500 going back to the low in 2009. And as you can see here, you have, you had the initial move off. We've had some corrections. Here was a 17% correction back in 2010. Here was a 21% correction back in 2011. And then along the way, we've had kind of some 8, 9, 7, 6, 10 here. And then here we've had we had a 12.5% back in August. And then this correction from top, the most recent top to the low, has been 14.5%. So the reality is we're still well within what we like to say normal correction parameters. I know losing money never feels good. That's a fact. But the market, unfortunately, doesn't just go up, 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 and stay up. It goes up, comes back down, goes up, comes back down. And at this point, we're still in normal correction parameters. Usually anything from 0 to 20% is what we consider a normal correction. So there's been a lot of words lately about bear market, and we very well could be in a short-term cyclical bear market. I'm not saying we're not, but at this point we're still in a kind of a correction phase here. So so while it hurts and while there have been some losses, we have to realize this does happen regularly, and it's a normal part of owning stocks. We like to say here that one of the price admission owned stocks is there will be periods where we go through some volatility and there will be some losses over short periods of time. Okay, this is just a quick, again, same time frame. But what I wanted to show you here was again, this black line is the S&P 500, which we were just looking at. This blue line here is the size of the Fed's balance sheet. So basically, when the Fed was increasing their balance sheet and they were buying assets, we call that quantitative easing, QE, it pushed the market higher. And every instance here. And so sure enough, at the end of 14, the market went, the Fed kind of went on hold. And sure enough, the market's been, in a sideways, volatile kind of pattern here while the Fed has done it. And this really gets to the crux of it. What is a catalyst then that's going to push the market higher? We'll talk a little bit about that here as we move on. So one of the other things about this market is when we look at the individual sectors, this kind of helps us determine what is doing well and what's not doing well within stocks, right? And so if you think about it, right, there's sectors that are defensive in nature and there's sectors that are cyclical in nature. A defensive sector would be like utilities or consumer staples, right? You're still going to pay your power bill no matter what's happening. You're still going to brush your teeth and buy soap and do those things, no matter what's happening. But are you going to get a loan and maybe invest some money or buy something? Are you going to, maybe take that trip and use, some energy, or are you going to buy some extra whatever? Those tend to be more cyclical in nature, right? And whatever sectors are outperforming at different times kind of gives us a gauge of where people's mindset, right? So it's no surprise as we look year to date. We'll just kind of focus on this column right here. Well, the best sector year to date are utilities, okay? And it's up 5.3%. Second best sector year to date are consumer staples, which is just slightly down. What's the worst sector? It's actually not energy, which a lot of folks would probably think, but it's actually financials, which is financials. You can make a case is probably one of your most cyclical groups that there is out there. Of course, energy's down. Of course, discretionary's down. Again, a lot of these more cyclical names tend to be down right now, and your defensive areas tend to be outperforming. So we are definitely in a defensive posture from an investment standpoint, and also from an economic standpoint there, without a doubt. And again, this speaks to the same thing. One of the things that we spend a lot of time looking at is market breadth, and this tells us here, so of these sectors that we were just looking at, what percent of the stocks in those sectors are above their 50-day moving average? Well, guess what? Meaning if you're above the 50-day moving average, you're there's some strength, you're doing well. Utilities, telecom, consumer staples, again, all defensive areas. Industrials, technology, materials, financials, energy, these tend to be your more cyclical areas. They're all performing the worst right now, okay? Let's go ahead and forward. I'm going to turn this over now to Greg Towner. He's going to talk a little bit here. Let me get him on the video. Okay, there we go. All righty, Greg.
Yeah.
All right, excellent. So Greg's going to talk over the next few slides. Take it away.
All right, thanks. One of the things that Brian and I talk about and we get asked about is, what are some things that we're looking for that might get us a little more confident in the market to maybe put some money to work? And so we'll be talking about some of the bigger picture, macro things that are important for that. But we think ultimately a lot of what happens in the stock market and as well as the bond market kind of moves first before you tend to see some of the economic data turn or some of that other data turn. So this chart here that we're looking at, this is the period between 2010 and 2012. And if you notice all those blue cross marks there at low points in the market, each of those, both in 10 and in 2011, signify individual days where the market was up and the stocks that were up on the day or advancing, there was 90% of the stocks were up on that day. And what we call that good breadth, good momentum surge behind the market. And that's what we like to see to have greater confidence that the market is moving higher. Now, of course, the markets are going to already have moved up a little bit by the time you see those, but it just gives you more confidence that the market isn't rolling over to another bear market, that it's just been a correction and now buyers are starting to come in. So that's what we like to see. Unfortunately, on the next slide, what we're currently seeing, if we look at, over the next, if we look over the past year or two here, we can see back in 2014 at that brief low, it just had a couple of 90% up days, but it was enough to push the market higher for another 6 months or so. But starting mid last year, the S&P broke below the 200-day moving average, that red line there. And on each successive sell-off and rally attempt, we just had very minimal, advancing breadth, not a lot of momentum behind it. So it doesn't mean that the market can't go higher without those. It just means it's more of a challenge. There's not enough buyers coming in, not enough volume coming in. So it's really, for us to have a great deal of confidence, we would not only want to see the breadth numbers improve, but get back up over some of these moving averages that have been increasing in rate for several years and now are flat to declining. That's one key thing that we'll be watching as far as the market. Now, when we talk about interest rates, what we're looking at here up at the top, the orange line is the Merrill Lynch corporate bond yield. So basically what yield you're getting if you invest in a broad index of corporate bonds. And you can see here in the last year or so, that's been going up, meaning people were demanding higher rates to invest in corporate bonds because they were deeming them a little riskier. And the black line below it is the 10-year US Treasury rate. And you could see that particularly recently, that had been sharply declining in rates, meaning there'd been a flight to safety. People were not willing to invest, whether it be other fixed income or equities or what have you. They were going to, what is perceived as the greatest, risk-free type rates. And so if we look at the bottom, we can see that the spread between those two over the last, year and a half or so has been increasing, and that has only increased at a more rapid rate recently, showing that there's really been it's been a risk-off market. People do not want to take much risk. They're sheltering down. They're afraid. And so what we'd really like to see to have greater confidence is that money's being put to work in riskier assets, so that this spread at the bottom, at the very least, flattens out and preferably starts to turn down. So that's another thing, along with the stock market breadth, that we'll be keeping an eye on. And this takes us into something a little different here. You've probably heard a lot about, corporations buying back shares, raising dividends, and all of that. And both of those can be great things at different times. But what we've seen lately is companies have been issuing debt, taking advantage of the low interest rates and issuing debt, seemingly for the single purposes of buying back shares and paying dividends. And so I think, the market here has been seeing that the shareholder payout yield, as it shows, that black line that's been increasing, is getting to be at such an extreme level that what it's doing on the next slide is actually the buyback shares. This is an index that represents the most commonly owned stocks that are being bought back, and done great for years. But now here recently, in the last year or so, you can see it started to underperform. I think there's some reasons for that. Number one, the market's probably perceiving that companies are now buying back shares at too high a valuation. It was great when the shares were lower, but then the shares got too high, and so it's not a good use of their capital. And then also, it's just they're increasing their debt levels. And what I think the market would really like to see, and we'd really like to see, and this is a bigger picture thing, is them putting that capital to use for growth. It's great that they have great balance sheets and they're preserving capital and they're buying back shares and they're paying dividends. But in order for it to grow, the company and the economy as a whole, frankly, we'd like to see them reinvesting back into business some more. That's another thing we'll be keeping an eye on, and that's really more of a longer term thing. You hear us talk about, and you hear the financial media talk a lot about the U.S. dollar. This is really another very important thing that has been affecting the market for a while. And you can see back in 2014, the dollar just really exploded higher. And then, lately has been trading in a very much a sideways range. However, if you listen to any corporate earnings calls or read their transcripts, it seems like every single one is blaming the dollar for decreased earnings. They're showing their earnings before the dollar, after the dollar. And so the dollar has really been the only currency that's been increasing. Down at the bottom of the screen, you can see all of our other major developed markets have been decreasing their currencies, and really it has amounted to a currency war. And so it's been the increasing dollar has been a headwind for a lot of U.S. corporations. It makes their goods and services more expensive overseas. And so for us to get really constructive on the market, we'd like at the very least to see this dollar stay in this consolidation phase, but preferably weaken a little bit to ease the strain on company earnings. And this is really just another look. Again, not only have developed markets been weak, but really the emerging markets, China and Brazil and so forth, have been exceptionally weak. Some of this is the countries trying to devalue their currencies in the hopes of boosting growth and so forth. But you can see that they've when you have currencies down this much, there's obviously some sort of currency battles going on, and or severe economic problems in other parts of the world. So the U.S. dollar strength in correlation to other currencies is another factor that we're going to be keeping a close eye on. This just kind of summarizes some of the key points that I made. The yield spreads we like to see tighten. In other words, we want people to take a little more risk, not be afraid to buy some corporates and so forth. We just talked about the dollar declining. In the stock market, we'd like to see the breadth improve, good volume and good surge. Brian showed what the sectors have been doing. Instead of just utilities and consumer staples doing well, we'd like to see some of the cyclicals do well. And they've done here pretty well the last few days, but that's just a very short time period. In the meantime, as you may be aware, we're definitely holding a good amount of cash across most of our strategies. Trying to be in a defensive posture. You never know when a minor correction like those on the chart Brian had showed could turn into something worse. So we're trying to maintain a defensive posture until some of our key factors are met. And if the market did end up selling off more, we feel like that would provide us an opportunity to deploy cash. But even if we had to wait till the market moves up some to deploy it, we'd rather be more confident in the environment we're in rather than just putting it to work because the market's taking off on us. So we'd rather have some of these factors met before we deploy a lot of capital. So that's what we're looking for a bottom, and I think Brian's got a few other points he was going to go through here before we get to the Q&A.
Yes, Greg, thanks. Thanks for your comments there. So yeah, just a few more points here. Again, this is kind of our checklist of what we're looking at, where we're going to feel a lot better about investing back in the market. I do get asked a lot about the Fed. I do get asked a lot about, are we in a recession, things like that. So I just want to take the next couple of minutes to address that, and then we'll open it up for Q&A. So this is this kind of just tracks when the Fed is likely to do the next rate increase. So, this is March, April, June, July, September. These are the next Fed meetings. And as you can see here, since the beginning of this year, they had the Fed increase 25 basis points back in December. And then after this year, these probabilities have gone down dramatically. So really at a 50% probability right now, in September would be the next Fed increase. And it'll probably be very small and very measured. So at this point, we just don't think in this environment right now, the Fed's going to be aggressively raising rates. At least that's what the market is expecting. And I would be very surprised if the Fed goes against that. So yes, the U.S. economy is slowing down. There are some things happening there, and the Fed will probably hold off there a little bit on that. Quite honestly, whether the Fed funds rate is at 0.25 or 0.50, if they do another 25 basis points, I think in the grand scheme of things, it really doesn't matter that much. Again, what's always mattered to us is the rate at which the Fed's going to raise rates, meaning you can go up 25 basis points for a while, maybe do another 25, another bump, kind of like measured like that. We think the market, that'll be good. If it's like in the past where they just tighten very sharply, we just don't see that happening. Another, positive right now is that employment continues to remain strong. Jobless claims continue to remain low. As you can see, going back to the 60s here, every recession, that's what these gray bars are, just about every recession has been preceded or coincident with a spike in jobless claims, and we are nowhere near that at this point. So it's obviously a number we look at, but at this point we're not really seeing any lift off there. The second thing, again, this is going back to the 60s. Every recession has been, bear with me 1 second here. There we go. Every recession has been preceded by a negative, what we call a negative inverse yield curve. And what that means is just know that the yield curve goes negative before a recession. I won't explain all the intricacies of it. And the yield curve is flattening. Matter of fact, this is a few weeks old, so it's actually dropped. It's probably sitting somewhere around here, but we are nowhere near a negative yield curve like we've seen in the past. Now, does that mean we're not going to be in a recession? No, it just means that yes, the yield curve is flattened, but there still is some steepness to it. Where in the past the yield curve went completely negative and it preceded a recession every time. Just taking a big kind of, again, we always like to step back and take a big picture view. Again, this goes all the way back to the 30s, S&P 500, 5-year rate of return. Yes, there were some 5-year periods that you had some losses. I would argue that if you buy stocks for a 5-year period, that's a pretty short time to just buy and then completely get out. 10-year period, you had the Great Depression, you had 10-year periods with losses, and then going into 08-09, you had a 10-year period with a loss there. But other than that, there have not been a lot of 10-year periods with losses. If we get to 20-year periods, there's never been a loss in the market. So, while stocks are down and the natural inclination is to go ahead and sell and get out because, oh my goodness, we're down and people are talking about bear markets and it's reminding us of 2008 again and all these things. What's more important is, how are we positioned? We're positioned with some cash. Yes, the market could go down lower, but we believe over the next 5, 10 to 20 years, this is going to present us some opportunities here to buy in. And so we want to be in a place where we can do that. We're not trying to time the market. We're not trying to say, hey, let's sell here and then we'll buy in here at the low. But it's just we reckon, and that's why we're not, we're never going to be fully out and then fully in or fully out. But we just kind of slide along that scale a little bit of, do we want to be, are we embracing risk or are we pulling back a little bit? We're in a defensive posture right now, no doubt. We do think that this is not going to last forever. It will change here at some point. So here are the negatives. And we talked about GDP is low, the economy is soft, the Fed's probably going to hold off for a while. Just like I said, don't let the words bear market scare you. There's all types of bear markets. There's a secular bear market, cyclical bear market. You're going to hear probably more and more in the media this word bear market. And immediately we think 2008, oh my gosh, we're going to lose 50% of the value of our stocks. No. Cyclical bear markets happen all the time. And usually it's defined by a loss of about 20%. We've not even, we're still about 5 to 6% off even hitting that point yet. And over the last few days, we've had a nice little rally here, so we're even further from that. We believe this next year, the election is going to be a distraction. Sure, it's fun to talk about, and we love to make correlations with who's going to get elected and how it's going to affect stocks. We really just don't. We really believe that you just be careful making that correlation. Very rarely does it work out like you think it does. The election's important. When I say a distraction to stocks, investing, the economy, things like that. Recession is still a question mark. Again, things are slow. We could see a negative quarter GDP growth. You need 2 consecutive to be classified as a recession. Of course, the world economy is soft. Everyone is fighting deflation right now. It means that everyone's brought rates low. In some cases, negative interest rates. So that's just the nature. That's just where we're at. China, of course, a lot of talk about China, very low growth there. They're manipulating their currency somewhat, and that's create a lot of volatility and spook some folks. That's another negative. And then lastly, earnings per share over the past 6 months has definitely been declining here in the United States. So, like Greg was saying, a lot of companies have been buying back their shares, and that's been increasing the earnings per share. But that top line revenue number is still flat, and in some cases declining a little bit. So companies are kind of been at their highest profit margins for years. So there's not a lot of room left for them to pull out earnings. And so what we're seeing is very natural. The market's pulling back a little bit here for that reason. Positives. Employment's strong. The consumer is still strong. Fed's likely going to hold off raising rates near term. That's a positive. Again, don't let the word bear market scare you. I just put that here again. Again, the election is a distraction, and it's another positive here. Housing prices continue to rise. So the housing market is recovering. Real estate in most markets are doing very well and continuing to improve. And the other thing I think that gets lost on this, and this is why we don't think we're going to see a 2008 again, is that balance sheets on companies, especially in financials, are the strongest in many cases they've ever been historically. And some of it's regulatory driven, some of it's just been companies are hunkered down, and they're very well capitalized right now. So if something happens or we do go into a recession, we don't think companies are so levered like they were in the past that you'd really see a maybe substantial move. Obviously, energy has been pretty levered, and with the drop in oil prices, we've seen that go down. We feel that's getting at or near somewhat of a bottom. But across the board, companies are actually in some of their strongest things. So yeah, we could see a drop in earnings, and you see stock prices come back. And again, we look at that and say, okay, this will allow us to buy some assets at some cheaper prices, and we can take some of that cash and move back in. So there's definitely some positives out there. It's not all negative. I'll go ahead and stop there. We'll go ahead and start some Q&A. So let me go ahead and stop the recording, and I'll open the lines up for some Q&A.